The stock market is still struggling, still coping with the possibility that excessive rate cuts from the Fed may not actually occur in 2019. There is some fantastic news for these desperate investors though. If things do get bad, the Fed will drop rates. Fantastic, excellent. Investors can rejoice. All roads lead to easy money. You came here for the truth, so let me unveil that for you. Today we are going to talk about what happened with the Federal Reserve. We're going to look at the stock market. I'm going to show you the yield curve inversion once again. All of this information is so important, and yet the mainstream media reports on nothing but garbage. You have to connect the dots together if you want to understand the big picture. Let's begin with the markets themselves. Right now, we're looking at this just after 2 p.m. The market is sitting at minus 512. This is going to fluctuate. The plunge protection team will surely be able to restore some of this before the end of the day, but nobody really knows. Usually towards the afternoon, we see the plunge protection team coming in and doing their job as they always do. Of course, we'll see what happens. You can see that the S&P, NASDAQ, and the Dow Jones all in the red for the day. Now, why is this the case? Why did this happen? Well, we're going to talk more about that. I'll show you the details here. Take a look at this first. Stocks fall as Powell fails to give investors a clear signal that a rate cut is coming. Now, they already cut interest rates. They just did so, but they want more. They at least want to know that for sure, we are going to see more rate cuts. It's just a matter of when. But Powell has said we will act as appropriate to keep this expansion going, to make the longest bull market in history even longer by a long shot. Of course, this is exactly what they are trying to do, what they're saying they're doing, but they always create distortions and dislocations because in order to keep interest rates this low, even where they are today, you have to print money. You have to engage in open market operations. If you want to push it down even further, you have to be in the market more aggressively. This doesn't come without consequences. That's why things are screwed up today. People are always worried about the short term. I want the stocks to rise now. I don't care what's going to happen 4 years from now. I'm invested right now. I want the stocks to go higher. I don't want to see any sort of correction whatsoever, not allowing that to happen. So bring the interest rates down even further. I don't give a damn. This was obviously at the forefront, the big news of the day, even though it's already been pushed off to the side. This comes directly from the Chinese government website. It's a translated article, but this is the gist. The State Council Customs Tariff Commission issued an announcement to impose tariffs on approximately $75 billion worth of imported goods originating in the United States. As you can see at the bottom, August 23rd, 2019, looking at the brand new tariffs that are being put in place by China. Now, I know a lot of people love to measure them up against each other and say, look what the US did and look what China did. Wow, the US has more firepower and so on. That is not how it works because you can see the immediate reaction that this caused by the US. They started to freak out and they said, we're going to react. We're going to make sure that China feels it. Well, both sides get hurt when this activity takes place. And that reason is simply because higher prices on products that people buy. Now, maybe you don't need to buy necessarily all of that garbage that's available out there, but however people want to spend their money, it ultimately benefits the economy, okay? One way, shape, or form. If you're buying stuff, if you're going to the movies, if you're going to the restaurants, that helps to keep people employed. If things are more expensive, they go further into debt and potentially buy less stuff. So either way, it is not a good thing. I don't think that people have realized this yet. They are so focused on the immediate result. This is so important, but this was ignored by the mainstream. The IHS Market Flash US PMI actually dipped into a contraction. Officially, it is now at 49.9. Okay, as soon as it makes it below 50, it is officially contracting. It is now at a 119-month low. I've been showing you this data over and over again. Here you can see what had occurred. Of course, these numbers fluctuate all the time, but you can see the trend. It's down, down, down. This is happening all across the world, whether we're looking at Europe, or the US, or anywhere else. We see the trend of weakening, of contraction, a build-up to recession. Many places are simply hemorrhaging, and there's no other way to put it, okay? So let's move on to this. A slump in freight shipping flashes warning signs for the economy as US-China trade issues rage on. Air freight volumes fell nearly 5% in June, the 8th consecutive months of decline. This is directly linked to what is happening with the US and China trade issues. Of course, you can't get around this by something that the Federal Reserve can conjure up from a printing press. It is never going to work like that, but of course, that's what the market wants. They want easy money because they don't know what else to do. Underlying all of the trade issues, of course, is that globally there is a weakening. There is a stagnation that has been going on for a little while, and they are trying to stimulate as much as they possibly can, and this always ends in disaster. Here you can see the chart form market US manufacturing PMI, the blue line moving down below 50. This is definitely troublesome. I'll just show you right now, looking at the green line, which is the ISM manufacturing PMI. Both of these, in fact, coming down and have been doing so since 2018. So it's not something that just happened to occur this week. It's been going on for a while. Powell said that there is no rule book on trade, pledges that the Fed will act as appropriate to sustain the economy. That's right, they will act as appropriate. When you look at certain numbers, whether it's the core PCE inflation, whether we're looking at the jobs numbers, whether we are looking at any of these fake things that they put in front of us on a daily, weekly, monthly, or annual basis, all of this information here will show you that things are okay. Maybe it's not where they would want it to be, but certainly it isn't a big issue. Then when we look into the details for real, the information that we actually want to be looking at, yes, we start finding out the truth. But that's apparently not where they're looking. They are looking at unemployment rate of whatever 3.7% and so on. So it depends on the data you look at. But of course, this information here shows you that the Federal Reserve is simply waiting and seeing. They said this when they decreased interest rates, and yet here we are today. My goodness. Check out what Larry Summers said in these two tweets. I'll read this for you. We usually agree with Janet Yellen, my favorite, but believed at the time of her 2016 Jackson Hole speech and believe even more in today's world of 150 basis points 10-year rates that her optimism about the existing monetary policy toolkit is misplaced. Check this out. There is little room for interest rate cuts. In every U.S. recession since the 1970s, the Fed funds rate was cut greater than 500 basis points. In most, the real rate fell more than 400 basis points below the neutral rate. Now the max feasible cut is 200 to 300 basis points, bringing the real rate to only 150 to 250 below neutral. There you can see the chart at the bottom. Essentially, we have very little room to cut. They are going to have to go into the negative. And we've already heard the talk about there's no reason why we can't go into the negative. Why not? But look at what it has done in places like Japan, and look at Europe as well. It has completely destroyed their system. And of course, eventually they're going to have to deal with the problems that are quickly building up. The froth may not be off of leverage loans just yet, but with 5 deals falling through in the past few weeks, the market is definitely a little less giddy. The leverage loan market has been a favorite of private equity firms, funding payouts to partners and buyouts of targeted companies at a record low borrowing cost for a decade, doubling in size to about $1.2 trillion. Now it's experiencing a rare moment of sobriety. Investors who smell a recession are shying away from companies that just a few months ago might have been an easier sell. This is what I've been talking about with the CLOs, all of the derivative products that exist, all of the financing mediums out there potentially available to people come at a risk. Today, we have some warning flags. It's not just failed offerings that are flashing yellow caution lights. Some borrowers have come to market and had to pay more than they originally planned. The possibility of continued rate cuts by the Fed has made floating rate deals less attractive, and companies vulnerable to the trade issues have had to promise higher yields. This article goes on. I'm going to show you the chart, and then we're going to finish the video. Fund outflows as retail investors yank cash. Loans rely more heavily on CLOs. That's when we get into the danger zone. We're talking about these ridiculous derivative products that exist, as far as I'm concerned, for no reason whatsoever. Instead, what they do is they pour more money and more money into these insane, they call them assets, but quite frankly, I just can't use that word, whatever you want to call them. And today we have them going and compounding everything that we see. This is the net US loan fund flow. Things changed last year in 2018, along with the market falling, along with the manufacturing taking a dive. Everything started to happen towards late 2018. And now this year we are dealing with the effects, and there doesn't seem to be any change in this regard. I'm going to end the video there. If you found it informative, please hit that thumbs up button. It's one button, just click it. You are supporting this channel. Hey, wait a minute. Do you want to make passive income? Do you want to actually earn some money aside from your primary job, your 9 to 5? Well, then I created a course that is completely free. It's a step-by-step guide to how to sell on Amazon. I call it the Amazon GPS. There's no trick, there's no catch. I literally created a free course in hopes this will be the absolute biggest Amazon course that exists. It's on pace to do so. I hope that everybody will join. Click the link in the description and I'll see you over there. Whoa, hang on. These two books have all the details that you need that wasn't available to you all throughout your education. I'm talking about the foundation, the history, the asset classes, all of the activities that have been done up until this point right here. If you read these two books, you will know all of those details. Check them out at the link in the description if you want the audiobook that's available at themoneygps.com. If you want to see what's happening in the financial industry right now and you haven't watched this video, I break it all down. Click on it and I will see you there.